As a new investor, it's necessary you understand mutual funds. Apart from a better understanding of individual stocks, equities, it's also very important you fully have a knowledge of what mutual funds are all about. So, number one, I want to consider the definition of mutual funds. So mutual funds are investment vehicles that pull money from many investors who invest in a diversified portfolio of stocks, bonds, or other securities. And so each investor owns shares in the mutual fund, which represents a portion of the uh, holdings in the fund's portfolio. And these funds are professionally managed, they are actively managed. So mutual funds are managed by professional portfolio managers, who decides on the best investments for the fund based on the fund's goals and objectives. Number two is how mutual fund works. How do they work? Number one is they pool resources together, pooling of resources. So investors buy shares in the mutual fund, and the pooled money is used to buy a variety of securities, which include stocks, bonds, and maybe other asset classes. The value of the mutual fund shares is determined by the net asset value, which is the total value of the fund's holding divided by the number of shares outstanding. Number three is types of mutual funds. Types of mutual funds. So you have equity mutual funds, you have bond mutual funds, you have balanced mutual funds, you have index funds, as well as money market funds. So let me start with money market funds. Money market funds invest in a short-term, low-risk debt securities and are typically used for preserving capital. And when it comes to index funds, they track a specific market index. It could be the S&P 500. It could be the All Share Index in the Nigerian Stock Exchange, and it is aimed to replicate the performance of the index it is benchmarked against. It tends to mirror the performance of those index. You equally have balance fund. Balance fund invests in both stocks and bonds. It offers a mix of growth, obtainable through equities and income, from bonds. And then the other one is a bond fund. Bond fund invests in bonds and are typically used for generating, income at a lower risk. So as for equity funds, they invest primarily in stocks, and it is aim, for growth. They target an above average level of growth. Number four is a benefit of mutual funds. What are the benefits of mutual funds for beginners? Number one is diversification. Mutual funds provide an easy way of diversifying your portfolio, spreading your risk across a broad range of assets, a broad a variety of asset classes. And number two, they are professionally managed. A professional fund managers, take care of the investment decisions, making mutual funds a good choice for beginners who may not have the time or the skills or the expertise to manage investments. And not only that, you have accessibility. So mutual funds are accessible to most investors. You have lower amounts as capital. You can invest a minimum amount of money. In most cases, it makes it easier to start investing with a smaller amount of capital, the smaller amount of money you can invest. And not only that, we have to consider liquidity. Mutual funds, shares can be bought or sold in any business day, offering that liquidity, offering flexibility for investors. You could buy it, because they are traded on a daily basis. So you could just buy at any time because of the level of liquidity they possess. Please like this video and subscribe to this channel if you've not done that. Number 5 is there's this how do they really operate? How do you invest in mutual funds? You want to invest in the mutual fund, so how do you go about it? First of all, you have to open an account. You open an account. You open a brokerage account. So you can invest in mutual funds through a brokerage account, directly with the mutual fund company, or through your retirement account, like your IRA or your 401k. So open an account and then you invest through the account you've opened. Then secondly, you choose the fund you want to invest in. When selecting a mutual fund, consider factors like your investment goals, your risk tolerance, your time horizon, the fund performance history. Although past performance is not indicative of future results, but all the same, you may still need to look back at the performance of the mutual fund you want to invest in. It's also important to look at the expense ratio, which represents the cost of managing the fund. Different funds, have different expense ratios. So you may consider, expense ratio. And don't shy away from investing in mutual funds that did not perform well in time past, because they are likely to perform well in the future. And those that perform well in time past may not perform very well in the future. So you consider this strategy. Number 6 is cost and fees. Cost and fees. So you have expense ratio. This is the annual fee charged by the fund for managing investment. It's expressed as a percentage of the fund's asset. So it is a percentage of the fund overall asset that will represent the expense ratio. And it's what is called sales load. So sales load still represents, normally some mutual funds, charge a fee when you buy and sell shares, known as the sales load. However, many funds are kind of no load, meaning that they don't charge fees when you buy, and they don't charge any fee when you sell. It's a kind of no load funds. So you equally have other fees we need to consider. Some funds may also charge management fees, redemption fees, or account maintenance fees. Account maintenance fees, as if it is a bank. So when you sell your shares, you want to redeem your holdings, you want to redeem your capital, they charge you fees, redemption fees, and they also charge management fees. Number 7 is how mutual funds are priced. How are they priced? Generally, you consider what is called net asset value. So the price of a mutual fund share is based on its net asset value, which is calculated at the end of each trading day. The net asset value is the total value of the fund asset minus any liabilities, then divides by the number of shares outstanding. That will give you the net asset value of the shares, and that determines the price of the mutual funds. So in conclusion, mutual funds are a great way for beginners to start investing, because They offer diversification, they are professionally managed, and they equally offer ease of access. Although they may not perform as well as investing in individual stocks in equities, but it's good for beginners who wouldn't want to stomach the volatility and the risks associated with picking individual stocks.